and she's great at what she does. She's an awesome teacher. So I will pass it over to you, Nichole.
Okay, I thank you. So, this is a two-part presentation, part this week and part next week. And this is probably not the most exciting and stimulating class I have ever given. In fact, James kind of is always telling me it's boring. And it is. But this is fairly important. So we're going to be actually talking about staying out of trouble in a lot of ways with the Securities and Exchange Commission. So this has to do with raising money for our I'm sorry, I'm just trying to move something out of the way because it's kind of, there we go. When we go to raise money from private sources, more often than not, we are triggering part of the Securities and Exchange Commission rules for raising private money. We're actually, what we're doing, whether we know it or not, is offering a security, which is ruled by the SEC. And so what I want to talk about today is basically just kind of a primer on what are securities, what makes up a security, and the types of securities. And then next week, we're going to talk about the exemptions we use. So basically, this next slide after this one, I'm going to tell you what constitutes a security. Well, let's just go ahead and get going, and then I will get to that next slide. So a security, this actually comes from the SEC website. So it's an instrument that is generally some type of an asset that's traded in some way, shape, or form. And it can be, whether it is or isn't a security, basically depends on the jurisdiction where the assets are traded. And what that means in a nutshell is that every state in this country has its own securities rules, and they are generally different than what the federal rules are. And so if you are buying, so let's take this real estate. If we're buying a piece of property in Florida, then for us to use the Florida statutes, the people who are issuing the security, all of the investors and the property have to be in Florida. So the minute there is an investor that comes from another state, or the property's in another state, you are automatically triggering the federal law. And so that's an important thing to keep in mind. Now, most countries also have their own securities rules, and they vary a fair amount. So we're going to limit what we're talking to the United States, right? And it generally breaks down, and we're generally talking federal, into three types of securities. Equities securities, where you're actually having an equity or an ownership position, and that is frequently stocks, but it can also be real estate. The second time is debt securities. And those include bonds, they include banknotes, they include loans. So when we are raising private money, we have to decide whether we are going to be offering equity in a property or debt. Generally can't be both because they're different rules. They're different types of securities. And the third type is called derivatives. And that typically just means that what we are trading is derived from something else. And I have a slide here. We're going to talk about that a little bit more. So the next slide I want to talk about here is when something is actually determined to be a security in the United States. This comes from actually this was a Supreme Court decision back in the 30s, in the 1930s, and it was actually triggered out of Florida when somebody owned an orange grove and they were selling trees in that orange grove to different investors. And some of the investors, it didn't make money, and it ended up going through the courts and finally to the Supreme Court. So there are these 4 tests that are used to determine if something is a security or not. And those are that money is invested, there is an expectation the investor will earn a profit from that money that's been invested. The investment is in a common enterprise, that orange grove, that big orange grove, or a property that is going to be owned by an investor and us. And this is what tends to get us the most, this last one, that the profits are generated via the efforts of others. So what that means is that if you are taking money from an investor, and the investor is expecting you to make money for them, they expect profit, and they don't have any say. So they're a passive investor. They're a limited partner, so to speak. If they don't have any decision-making authority, if whether they make a profit or not is dependent upon you as the issuer, then it is a security. Okay. There is nothing here that generally says there is one person, so there's only one investor involved. So what that means, frankly, is that a lot of people who are out there raising private money to do their single family deals, most of the time you are actually triggering the securities laws. It is a security. There are sometimes, if you are offering a debt instrument with a note and there is a lien on something, it may not be a security, but it has to be set up in a certain way so that it makes it clear that it's not a security. Okay. The minute you bring in more than one investor into, like, raising money to do a rehab on a single family, it is a security because now you have more than one person who both have some interest in that property, and that their profit is going to be determined by you or not. Oops. Okay. So that means that we need to pay attention to this, because most of us that are raising money to buy multifamily property are triggering the securities laws. So what we're going to be talking about next week a little more is that in the securities laws, there are some exemptions. There are some exemptions that we can use so that we don't have to have security licenses. And that's what we're really going to be talking about next week, are those exemptions that we use to raise money. We still have to pay attention to the rules of the exemptions. And so that's why it becomes important to know what those exemptions say and what we can and can't do. So let me kind of move on. I'm going to just do really quickly here a brief description of the three types of securities. Most of the time, an equity security refers to a stock or share of an ownership in a company. Now, that can be, a company can be multiple people who own a piece of multifamily real estate, because we are forming a company most of the time. It's just most of the time when people talk about equity securities, they're talking about stocks, right? They generally have regular earnings in the form of dividends. Now, if we are talking about an LLC, LLCs don't give dividends, but they do have ownership shares, and they have, you have distributions that are equivalent to the dividends. Equity securities do and are known to rise and fall in value based on the value of the underlying security, the underlying property in our case, right? So if a property becomes more valuable and somebody has an equity share, they earn money, they own more, they make more money. If, on the other hand, for some reason, the value goes down, they lose money. And that is well known as part of an equity security, as opposed to a debt security, in that in a debt security, it's borrowed money, and the issuer is selling the security, but it is based on a promise to pay with interest. And so it's generally, there is, in properties, there's typically a mortgage, the property and the mortgage and the note that is attached to the mortgage and the property. And it's generally a fixed amount that has to be repaid, right, at a certain rate of interest, and the whole amount is due by a certain time. So what makes it different than an equity is that you typically don't rise and fall based on the value of a property or a stock. In a debt security, you are lending money at a certain rate of interest, and the interest has to be paid, and the capital has to be paid back, right? So typical types of securities are bank notes, treasury notes, all those kinds of things where you are actually lending money at a certain rate. Okay, so now let's talk about a derivative security. All right. So a derivative, the value of a derivative is based on its underlying asset that is purchased and repaid with interest, and the maturity date is also specified. So the difference is, so an example would be if you are selling options for corn, let's say, that that you are betting that corn right now is selling at $10 a bushel. That's the underlying asset. Corn is the underlying asset. And what we are selling is, in a derivative, is that we are selling that right now corn is selling for $10, and we're betting we're going to pay that, and we're going to expect that the cost of that is going to go up. And so we're going to make money because the cost in the future is going to be more than $10. But you can also lose money because it can go down. So a real common types of derivatives are commodities like we just talked about, also gas and precious metals, where we are betting that we are guessing that the price of natural gas right now is a such and such amount, and it's going to go up. So derivatives are generally traded by hedge funds to offset their risks of other investments. So, but you don't have to own the asset. You can just bet that the asset is the underlying corn is going to go up or down, right? And you can make a small down payment on that and then trade that. So the upside is that you can make a lot of money. The downside is if you lose and you're only putting a down payment down, you can lose that plus what the other cost would be. So just think about those three types of securities. I mean, and know that we as real estate investors typically deal in the first two, in an equity and debt. Some of the things that got us into trouble in the 2007, 2008 mortgage crisis is that a lot of these companies were selling derivatives related to what they thought was going to happen with mortgages. Was the mortgage interest rate going to go up? Was it going to go down? And they were putting small amounts down, and those mortgages went kaput, a lot of them, and these investors couldn't pay the difference of what was still owed. But we generally don't. I certainly have never done that, and so I think we are limiting ourselves to equity and debt, and more often equity. Okay. So now the last thing I want to talk about is 2 or 3 real quick slides here on who can sell a security. So most of the time we don't have security licenses. So we haven't gone through and taken the tests and things so that we can sell a security. Legitimate investment professionals, including financial professionals, registered representatives, investment advisors, all of those people have to be licensed with FINRA. And that is a financial industry regulatory authority, and the SEC, or your state securities or insurance regulator before you can sell anything. It depends on, so people who are selling insurances, life insurance, are typically having to have a type of security license. So that's what I just want you to know about who can sell securities. So remember back there that Howey test. If we are making the decisions for somebody to and they're expecting us to make money for them, that defines it as a security. We typically don't have security licenses. And so we have to depend on the exemptions, which we're going to talk about next week. Okay. So these are just 4 quick things that I picked up off of the SEC and a couple of other sites here, that the U.S. Securities regulates public offerings and sales of securities. So anytime a stock goes public, right, it is regulated by the SEC. And it has to be registered and filed. So you guys, when we're doing, when we are raising money and we are taking in private investors, right? We are still required to register what we are doing with the federal government, unless we are just dealing with a state, and we have to register with the state where, if we have investors from 3 states, the property's in a 4th and you're in a 5th, then you have to register basically in 5 states. The good news is that you just have to let them know you're using federal law. That's one of the main reasons we need to be using SEC attorneys when we're doing syndications and other kinds of things like this. Because if we don't register, we can find ourselves in trouble. Okay. Publicly traded securities are listed on the stock exchange, and you can see everything there is about those securities when you're looking at the company. Okay. Over the last few years, some of the securities are now traded over the counter or directly among investors, right? So we can either online or by the phone. And if you don't sort of understand sort of the underpinnings we're talking about here, if you start doing some of this stuff without really understanding what you're doing, and we'll talk about that next week a little bit when we talk about one of the exemptions, and find yourselves in trouble. I'm not trying to scare you, because there are some fairly simple rules. If we follow them, we keep ourselves out of trouble. Okay. The secondary market is also known as the aftermarket. You can just transfer some of your one security to another person, and basically we see that happening in real estate, where you can where one of your investors may want out and they have somebody who wants to step in their place, or you're not quite ready to get out of an investment, but one of your investors is in trouble or something and needs out, and you're going to replace the investor. Okay. Those are really things that we're doing on the secondary market. And about the only place the SEC really gets involved in that is that they tell you that from the time you issue a security, or you doing a raise, that you typically can't sell one of those equity or debt positions for a year. That's what most of the rules say, is that you can't do this aftermarket trading for at least a year, right? Most of the time, this is a privately done between people, between people like me who raise money to buy properties, and somebody who wants to step into somebody's shoes. But it can certainly also be between private investors. And then it would depend on what the operating agreement said, how you would replace those people. All right. So the last thing is that public offering sales and what we do, I just said this, have to be registered and filed. And typically you're having to do some kind of update yearly. That's basically that your SEC attorney or somebody's going to do as long as that, as long as you have private investors in there. It's simple, but I've always used the SEC attorney to make sure that happens. That's what I want to talk about today. And the last thing I want to talk about here, I'm going to turn this over to James really quickly, and then we're going to take questions.
Excuse me. So, couple, I guess, of added value things for you. In terms of if you want more information or just kind of more of an overview with a couple of specific strategies that we talk about, there was actually a free webinar that Nichole recorded a couple of months ago about a couple of different things that you kind of need to get into the multifamily space and make sure that you do it safely. And that's the link right there, bit.ly. Whoops, where'd it go? There we go.
Sorry.
It's okay. bit.ly/passive wealth webinar. It's totally free. It's about 2 hours long. There's a lot of great information on there. So if you have not had a chance to watch it, I encourage you to do so. If you have any questions about anything multifamily related, we're always more than willing to help anywhere we can. This is actually an old email address. It's not info, it's actually support@passivecashflowforlife.com. So if you want to send something to us or whatever it is, I'll also put it in the chat, but support@passivecashflowforlife.com, and that comes directly to me. And then the YouTube channel, you can either use that link there, or just when you go to YouTube, just type in multifamily passive cash flow for life, and our channel should come up. And like I said, we've got a bunch of Teaching Tuesdays on there, and then we have meetups once a month, and we'll put those up there as well. And the Teaching Tuesdays also include questions. And a lot of times, even though the presentation can be great, a lot of times people learn just as much just from the questions that people ask afterwards. So the presentation, which I did so far, has gone about 30 minutes. And then however many more questions we have, our VA will edit it and put it up on by tomorrow night. She'll have it up. So we'll just open it up to questions. You can, we've got a small group. I think there's like 15 or 20 people here, something like that. So feel free to unmute and ask questions. Or if you're, shy, you can just type it in the chat, whatever you're comfortable doing.
Anybody have any questions? This is typically, did I put everybody to sleep?
Wayne has a question.
Okay, please go.
How cumbersome is it to manage investors while trying to also manage property managers for multifamily properties? It seems like trying to manage investors is more than a full-time job in its own right. And then you're still trying to manage property managers as well as find new deals.
Well, two things I would say to that, Wayne. Number one, that's why we always say commercial investing, multifamily investing is a team sport. There's a lot to it. And so trying to do this by yourself is tough. The second thing I would say is the best way to deal with investors that I have found is that you are going to, right after you close, you're going to have a conference call with all of them and telling them what happened and what's going on and how you're going to manage this. And typically what I do is that I have just always had quarterly calls. And if something happens, on a property, I will send out an email to somebody to let somebody know. I also send out basic financial information about once a month to somebody, to the investor, so they just keep abreast of what's going on. It's their property too, that most of mine are equity. And so if I had debt partners, I'm just going to, my operating agreement is going to say when I'm going to pay them and how much I'm going to pay them. And they don't need to know a whole lot about what's going on with the property, but I try and keep them aware of what's going on, so they aren't hit with surprises. So the thing that bothers investors more than anything is when somebody goes silent, when you don't hear from them, and you can't get in touch with somebody. Everybody imagines bad news. So and bad news doesn't get better with time. So typically let people know and that you're working on things. But my general way of working with investors is to let them know how we handle things. And that's going to be that we have quarterly calls, and it's not infrequent that in the first 2 or 3 months that I have a property, we'll have a brief call every month just to let people know what's happening. And we do kind of a brief report about what's happened in the last month to the property, what's going on, to just keep people in the loop. And so, it's really about managing expectations, I think, more than anything, Wayne. But managing property managers, it's also the first 3 or 4 months. It's the most intensive, where you have to get the rules of the road straight and everybody needs to figure out, what's going on. But you're going to find it's a whole lot easier if you have 3 or 4 people, at least 2 or 3 people that are on your team, and you can share roles. That answer that question, Wayne?
Yes.
Okay. Yeah, I don't want to scare people away with this. I really don't. I just think you need to be aware of what the rules are, so you don't get yourself in trouble because you just didn't know what you didn't know. Other questions? Other questions about anything real estate related?
Hi, this is Chris Broussard. I have a question.
Yeah.
If it's anything real estate related, we have a deal where we're looking to acquire an 8-unit building, and it's titled in an LLC.
Okay.
And we've never done so. This deal, we would be acquiring the LLC that owns the building, and we've never done that before. We've always just done traditional transfer of title with a smaller duplex or triplex.
Yeah.
Is it very complicated and quite common, I would assume, for a title company to do an LLC transfer rather than a title transfer?
It happens. What I would say is there's probably a reason that they want you to just step into the LLC. And you need to know what that reason is. Because what you're also doing by stepping into the LLC is that you're accepting all of the liabilities that have happened in the life of that LLC. So if there is a suit pending, or
Sure.
somebody fell a year ago and is just debating, and it's the same LLC, then now you are responsible for that.
Right.
Right. So
Mhm.
common reasons to just step into an LLC are things such as there's a prepayment penalty if they sell it out. there may be a bank loan hanging out that is in the name of that LLC that you're going to step into that loan. So it happens. And whether I would want to step into an LLC, an existing LLC, basically depends on how long that LLC's been around. And if
Sure.
there's anything going
Exposure wise.
on. Yeah, that would, and so that's
Okay.
maybe a little due diligence. Do you know why they want you to step into the LLC?
Well, I think it's advantageous to avoid transfer tax, which in Maryland is 3%.
Yeah, it is. You know, that can be, that is an issue. And if somebody finds out about that, you know, you're gonna be in trouble. If they find out that the ownership of the LLC has changed. So sometimes a way to think about handling that is to leave to purchase, I'm making this up, to purchase 95% of that LLC, leave the existing owners in that LLC for the next year, and then have something in your contract where you're going to buy them out for a nominal amount. That way, you really aren't transferring the entire thing, if that makes sense.
Okay. I thought this was more common, but it sounds like based on what you're saying, it's not.
It's not uncommon because there are a number of states where, you know, transfer taxes are high, but if somebody finds out about it, it is, the law in a lot of states are moving more towards, you know, what was the intent behind you buying the LLC? And if
Okay.
the intent is to avoid transfer tax, you're going to find yourself in trouble.
Okay.
So you know, I can't honestly tell you how often it happens because I just don't have a really good sense of that
Okay.
to be often, but you know, I just told you what, you know, why I would, what my thinking
careful.
would be, whether I want to do that or not.
Okay. No, it's very helpful. Thank you.
Hey,
Yep.
Nicole, I'm curious, for him specifically, like you can do a title search and get title insurance when you buy a standard property. Is there a way or some kind of process that he could go through to find out what the history is of the LLC and if anything's pending?
Yeah, and title searches are not going, title searchers are not going to show up unless there is a judgment and a lien on that.
Right, so I'm
Mhm.
asking, is there a way for him to check, not so much a title search, but some way he could check the LLC to see if there's anything pending on the LLC?
You can check, so one of the things I always do with due diligence is I want to get their deck pages from their insurance. And I'm going to call the insurance company and find out if there's been any suits in the last 4 or 5 years or anything that's pending. If that's what you're asking with that.
Yeah. Sounds like
Yeah,
it.
so that's just part of regular due diligence,
Okay.
to kind of see, about that. But you don't know what you don't know. And the problem with well, it's not a problem. The thing to be aware of, I've talked about this more than once in commercial real estate, is that people can't lie to you. That's fraud, but they don't have to disclose.
Sure. Right.
So if somebody has said, I fell a year ago and I'm thinking about suing, the owners don't have to tell you that. If you ask that directly, they can't lie to you.
Yeah.
But, you know, but that's up to our due diligence to try and figure that, that out.
Okay.
Did that catch that better, James?
Yeah, absolutely.
Okay, that was a good question.
Oh, thanks.
Others? There's somebody still in the waiting room, isn't there, James?
No, one person's had to get in a couple of times, but I've let her in each time.
Okay. Well, okay,
I have a question, Nichole, Sharon.
yes.
Who regulates the SEC, and is it criminal or civil? And how do they find out, who's the whistleblowers that find the violations?
Okay, so the SEC is a government administration, sec.gov, and it's a commission. I don't know, they are regulated by laws and by federal kinds of things. I do not believe they are part of like the any other major federal government office, if that's what you mean. If they are, I'm not aware of it. There's a lot of different kind of commissions and things. Like I think FINRA is part of finance, part of the Department of Treasury. But I don't think the SEC is, but don't take that to the bank. The other thing you asked about, what was the other thing you asked about, Sharon?
How do they find out the companies that are violating the SEC, or or who the whistleblowers out there that
There is actually there's actually on the SEC website, one of the 506 rules is basically B, and it's the bad actor clause, which says that if you have been caught and are deemed to be a bad actor, that you are that your information is published. It goes to banks, it goes to a lot of people. It should be up on the SEC site somehow. And most of the time, if it's significant, you are banned from ever raising money or being a part of raising money again. So whether that's going to catch every person, I doubt it, because I don't know that they publish the actual names of everybody who's been involved in a company or so that has been deemed to be a bad actor. But I also think you could probably get that information under Freedom of Information. And to be honest with you, Sharon, I have never really dug down into the SEC website to see if I can find names and stuff. So it's reasonably uncommon. Most of the time, the SEC is going to go after the big guys because they don't have a lot of people. But where we can get in trouble is that now they're not generally going to go after little guys. But if one of your investor complains to the SEC, they can shut you down while they investigate. And if you are not in compliance with these rules, now you find yourself, with big fines and big trouble. I doubt if somebody our size is going to end up on a bad actor list, but it's certainly possible. Did that answer that, or did I not? Did I miss something of what you were asking?
No, that sounds great. Actually, I was very interested in it. I wasn't bored at all because I don't know much about this topic, and you explained it very well. I enjoyed the presentation.
Oh, well, thank you. I can't thank you then. So it can get long and windy, but I appreciate that, Sharon, because I certainly hear from people that it's that it can be scary, and that it is long and boring. So thank you for that feedback.
Of course, I thought it was interesting. I might be a nerd, but
Yeah, well, you and me both. All right, other questions? All righty, well, if there are, Sharon and Jane are going to be talking here in just a little bit. They're gonna start about 7:30. Do you want to talk a little bit about what you guys are gonna be talking about? And then we'll circle back and see if there's a last question. And I'm going to stop sharing my, my screen. Maybe. And turn it over to you, Miss Sharon there.
Hi, everybody. Thank you for attending. Hopefully you can stay on for our talk. At 7:30, we're going to be talking about mindset. I know mindset, it's, got to get your mind right, and that way you can move forward and focus. So got a couple ideas and all. And at the end, I hope to do a little bit of a round robin to get people's examples and ideas. Bring people in.
That
Sounds awesome.
sounds good. I think mindset is the majority of what makes or breaks, makes you successful or not. The rest of this stuff can be learned, but mindset is the key.
Yeah,
right.
exactly. I agree.
All right, I'm gonna be quiet. I'm gonna mute myself. And if there, well, let me ask last thing, is there any last questions on anything real estate, commercial that anybody would like to ask? Okay, then I'm muting myself and I am turning it over to Miss Sharon and Jane, and they can just kind of see